Have you ever wondered if you have a healthy profit margin? What should the profit margin of a healthy real estate team look like? Today, I'm going to show you. My name's Andy Mulholland. I'm a retired real estate team leader turned real estate bookkeeping expert. I own Simple Numbers, where we handle hundreds of real estate team leaders' books and financial reporting here in the United States. Today, I want to share with you what a healthy profit model should look like for a real estate team. Let's dig in. So the first thing we want to do is make sure we're all talking the same language. And we want to talk about the 5 key numbers in any real estate team profit and loss statement. Now, the first key number should be our total revenue. This is the amount of money that our business generated in commission dollars. Now, keep in mind, that is before anybody touched a dime of it. So before your broker got paid, before your agents got paid, before you paid any of your bills, the true top line revenue of the business. Number 2 is cost of sale, or sometimes referred to as costs of goods sold. This is the amount that gets paid out then to the broker if they're owed commission, to our agents if they are owed a split, to referral fees if they're owed money. Any dollar that goes out that is associated to that sale is going to be considered a cost of sale. That leaves us with number 3, our gross profit. That's the amount we had left. We started with number 1, we subtracted number 2, and we were left with number 3, gross profit. This is also sometimes referred to as real revenue. Why? Because it's the actual number of dollars that hit the business owner's bank account. Number 4 then is what we would call operating expenses. These are the dollars we spent on running the business, oftentimes categorized into 3 main categories. Number 1, lead generation and marketing, or LGM. Number 2, people expenses, or PPL. And number 3, overhead expenses, or OVH. Number 5 then leaves you with your net profit. Okay. And we might also include any owner pay in that number. If for my example today, I'm going to include owner pay in number 5. So if you pay yourself a salary as the owner of the business, usually we're doing that for tax purposes to keep the IRS happy. They want to collect their payroll taxes. So I really see that, though, as profit that we paid ourselves in the form of a salary. So it really is bottom line dollars. Now that we're clear on the 5 key numbers in our real estate business, I want to talk about what the model should look like. So let's say we were starting with $1 million real estate team. They did $1 million in total revenue. The second thing we'd have to look at is our costs of goods sold, the amount that got paid out to the broker and the agents. Let's say in this example, it was $450,000. That would mean our balance then is $550,000. We started with $1 million. We paid out $450,000 to the agents and broker. We were left with $550,000 that hit our bank account. We now have to do 2 things with that money: pay our bills and pay ourselves in profit. Let's say our bills were $300,000. Maybe we spent $100,000 on lead gen marketing, $100,000 on people, and $100,000 on overhead, for a total of $300,000 in operating expenses. That would then leave us with a net profit and owner pay of $250,000. Now, how would that break out visually? Well, it would look something like this. The pie would be our total revenue, $1 million. Then we need to break out our costs of goods sold, which in this example was $450,000, or 45% of the pie. That left us then with the remainder of the pie, which was our gross profit, and that was 55%, or $550,000. Now, with that piece, that gross profit, we still need to pay our operating expenses. And so when we look at that number, it was $300,000, or 30% in operating expenses. So what does that leave us with? Our net profit of 250,000 or 25% net profit and owner pay. And so the question then becomes, is that healthy or is it not? Is 250 or 25% profit margin a healthy margin? The answer is it depends. Well, what does it depend on? Here's the answer. It depends on how much of the $1 million in total revenue the owner did in their own production. And so if we took an example, a real estate team where the owner was doing zero production, here's what most teams are looking for in terms of an economic model. They're looking for somewhere between 20 to 25% net profit and owner pay. That means we have 75% left of the pie to work with to pay the bills and pay our agents. Most teams I'm seeing are spending about 30% on operating expenses. Maybe that's 10% on lead gen marketing, 10% on people, and 10% on overhead. Okay. So what does that leave us with? One more thing we got to pay, and that is our costs of goods sold or cost of sale. And we have 45 to 50% left to be able to pay out agents and broker if we want 20 to 25% net. That's what I would call ideal real estate team model. Let's hit 20 to 25% net profit and owner pay. A healthy margin, as I mentioned, is 30% operating expenses, 45 to 50% in cost of goods sold. So if that's the model, if the owner is out of production, what should it look like if the owner is still in production? The more the owner does of the total production, the higher the net profit should be. Why? Because $0 goes out in cost of sale when an owner does a deal. 100% of that revenue goes to the bottom line. So the net profit needs to be higher. Let's just go back to this as an example. This example I used before. $1 million team with a $250,000 net profit. Is that healthy or isn't it? As I mentioned, it was dependent on how much the owner is doing in production. Let's just say the owner was doing $500K and the team was doing $500K and they only made $250,000 in net. You can immediately see that that is not a healthy model because the owner himself, him or herself, did $500,000, yet they only walked away with $250,000 in pre-tax profit. That's a problem. Now, if the owner did, let's use a different example. Let's say the owner did $100,000 in production and the team did $900,000 in production and they made $250,000 in net. It's looking a little healthier, isn't it? Well, I actually have a formula you can use to determine what your net profit should be while you are in production as a team leader. It all starts with beginning with the end in mind. In other words, what do you want your model to look like if you were 100% out of production? I gave you this example of 20 to 25% net, 30% expenses, and 45 to 50% cost of goods sold. I believe that's where you should be. Why? Well, part of this is because if it's less than 20 to 25% net, it's hard to get excited about that unless you just have a huge business, right? Like millions and millions of dollars. Maybe you could get away with a 10% net profit. But for most of us in our real estate teams, we need at least a 20 to 25% net if we were out of production in order for this to be worth building. Otherwise, frankly, I think you're better off staying a solo agent and keeping much more of your profitability and then making more money that way. And I do believe that you need to spend around 30% of your operating expenses in order to properly support your real estate team, which just leaves 45 to 50% in cost of goods sold. Now, I will tell you before I move on, there are real estate teams doing $200,000 in GCI running a model like this, and there are real estate teams doing 10 million that we do books for running this 20 to 25% profit model. So before you say it's not possible, before you say there's no way I could run these margins, I'm telling you, you're hearing it from the horse's mouth. I do books for real estate teams of all sizes that do this model. So I want you to know it's possible. But back to our question of how do we know if we're healthy while we're in production? There's a formula you can use, but you have to start with what you want your net profit to be when you're out of production. That's where we need to start in order for this formula to work. So again, the goal is 20, let's just even call it 20% net profit and owner pay. That's the goal with you out of production. So while you're in production, there's a formula we need to use. Here's what it is. For every 1% of owner production, and I'll tell you what that means a little bit in a minute, we're going to multiply that times the goal cost of goods sold, and then we're going to add that to the goal net profit and owner pay. That will equal our current in production net profit goal. Okay, so here's what that means. If you're doing 50% of the total revenue as the owner, what we need to do, let's say, is we're going to use that. That's 50%. We'll go back to our original example. On $1 million, if the owner was doing 500,000 and the team was doing 500,000, what should their net profit be percentage wise? Well, let's go down here. We're going to put that in. Owner is doing 50% of the production. Remember, for every 1%, they're doing 50. We're going to multiply that times the goal COGS. Well, where do we get the goal COGS? Right here. Remember, this is the goal model, 20 to 25% net. The goal COGS then comes right from here, 45 to 50%. So let's just go with 50%, so 0.5. Then we're going to add that to the goal net profit. What was that again? Let's just even go with 20%, as we said right here. So we're going to add that to 20. That will give us what we should be as far as a profit goes now. So let's do the math. 50 times 0.5 is 25 plus 20. We should be at a 45% net profit and owner pay now while we're doing 50% of the production, so that if tomorrow we decided we were going to step out, we would still be at a 20% net. Why? Because we're going to start paying an agent on the deals that right now we're not paying them on. So that is the formula to use to know if your profit is healthy or not healthy. So in this example, would 25% be healthy? No, it's too low. We should be at 45%. This person is 20% too high in something, either costs of goods sold or operating expenses. And I can tell you what it is, because we're at 30% operating expenses. That's not too high. It's that he or she is at 20% too high in costs of goods sold. They probably have the wrong splits with their agents, right? Or they're paying too much out in referral fees to Zillow or other third party outside of their real estate team, or their broker's way too expensive. But somehow at closing, too much of the money is going out for them to be able to have a healthy business. And we need to solve that problem. So that's how using this formula can really help us identify if we're truly running a healthy real estate team. Let's do another example. Let's say the owner is doing only 30% of the total production. Maybe they're doing 300,000 of the million and the team's doing 700,000 of the million. Well, then what should their profit margin be? Well, we're going to take that times 0.5 plus 20 will give us what their net profit should be now. So that's going to be 30 times 0.5 is 15 plus 20. They should be at a 35% net profit and owner pay. So in that scenario, we'd be 10% too short now at 25%. Now, let's say they were only doing, let's just even call it 10% of the total revenue times 0.5 plus 20 equals 25. Guess what? We're running a healthy real estate business at this point. Okay. So that's the formula to use, and you're going to change it based on what your goal is. If you were out of production, what kind of model are you building? And then how much production you're doing now. Let's do another example just for fun. Let's say we were going to run a model where we were only running a 10% net profit. We were still going to spend 30% on operating expenses. That would leave 60% to go out in costs of goods sold. This always has to equal 100, of course, because it's a pie. So let's use this model to run our formula. Let's go back down. Let's just say the real estate team leader was doing 10% of the total production. We're going to multiply that by the goal COGS. Well, what is it in this scenario? 60. So we're going to do 0.6 plus the goal profit, 10%. So plus 10. That will tell us what our current profit goal should be with an owner doing 10% of the total revenue. Okay. So we're going to take 10 times 0.6 plus 10. We should be at a 16% net profit and owner pay now, so that if we ever stepped out of production or we had a business that wanted to run without us and hit a 10% net profit, we would now be healthy. So that should be a helpful tool for you to use to analyze your own business, as well as others that you want to compare yourself to. If you're taking advice from somebody on how to run a real estate team, you better run these numbers for them to make sure they are running a healthy business. Because to me, the definition of a business is something that generates profit without our production. Doesn't mean you have to step out of production, but if you did, what would your net profit be? And that's the formula to use. If you want more information on this or other topics around bookkeeping and financial reporting for real estate teams, visit our website, where you're going to find a lot of helpful information. You can click on the vlog, where you're going to find other tools and videos and tips and tricks on how to understand a real estate profit and loss statement. And then we have a button on free tools where you can actually download our real estate specific chart of accounts. So I'm Andy Mulholland with Simple Numbers. Thanks for watching, and we'll see you on the next video.